If you've been in the game long enough, position sizing really is the most important thing if you want to grow your account or create income over time.
I think many traders, when they hear position sizing, they just think it's a side detail in trading. But is it not rather a fundamental aspect of successful trading?
Yes, absolutely, especially with options because they're leveraged. Position sizing is extremely important because it's going to determine your long term success. And I think beginning traders, they're a little bit more focused on what should I trade, different setups, technical analysis, those type of things. And so I think options position sizing or position sizing is a lot of times comes towards the end of your evolution as a trader, in which you have your strategies maybe locked down or what you're going to trade. And now you can try to scale up. So I think that's where that fits on the timeline of a trader. But if you've been in the game long enough, position sizing really is the most important thing if you want to grow your account or create income over time.
And an important part of risk management, as we will get back to. But tell me first a little bit about yourself as a trader, Eric.
I've been trading for, I don't even know, 15, 20 years. I started in options trading while I was still working. About 4 or 5 years ago, I quit my job to trade full time and work on my research analytics at Alpha Crunching. I launched Alpha Crunching about 2 years ago. And I think what I'm known for on my podcast and YouTube channel is really mostly trading SPX options. I do trade other things such as stocks and ETFs and covered calls and some of the traditional things. But with the advancement of the amount of expirations per week with SPX, there's a lot of focus on there because one of the things with position sizing is one, but the other thing that people don't talk about is really frequency of trades. So if you don't have a high enough frequency of trade, sometimes it's hard to follow a strategy. For example, if you have a strategy that only lasts or only triggers once a year, you're not going to check it every day hoping you get that one trade. So with SPX and 5 expirations per week, there's a lot of opportunity to have a higher frequency of high probability trades. And that's something I've zeroed in on the last couple of years.
And if we go to our topic, at least that I look at it, the position sizing is one of four very core elements, that determines whether a strategy will be successful or not. The first being, of course, the win and loss rate, which many traders are very concerned about. Second being let's say, the average win. Third being average loss, and then the fourth being position sizing. And the first three of them are what we call the expectancy, right? There's a formula for that, while position sizing, I guess, goes much more to the whole portfolio you have. Or how do you look at this?
That's exactly it. Your win rate, average size of winners, and average size of losers is really the game. And I think this is where you have to decide what kind of trader you are. And this is where I think your personality has to be decided on. And the most common example is high probability trades like selling credit spreads or something where the risk reward is really skewed. Like you're risking a lot, but you're to make a small amount. Let's say you might be risking $1,000 to make $100, but your win rate might be really high, 90 something percent. So the win rate, as traders get into that, they think that's really good. And that can be deceiving because you can win for a long time. You can win for months on end. And then all of a sudden something happens, the market turns or whatever. And now one trade can wipe out a bunch of losing trades. So for those that focus on win rate, you really got to look at the size of your wins and losers. And what I've found is the higher the win rate, the more skewed that is, the smaller the winners and the larger the losers. So that doesn't mean you can't trade it or manage your risk in different ways. But there's other people that kind of trade the opposite spectrum where they're okay with, let's say, a 40 or 50% win rate, but they know when those winners come, they're really large. But that can be sometimes harder to execute because if you're placing a trade and you think there's a 50-50 chance some people they don't want a 50-50 chance. They want to know, or at least have the confidence to put on that next trade. And with a 50% win rate, sometimes they're not as confident, despite the fact that the winner might be twice as big as a loser.
Mm.
But to the point, that little combination of win rate, size of wins, and size of losses is really needs to fit your personality. And then I think you can position size from there.
Actually, my main strategy is something I call zero DTE break even iron condor. I have another video about it, and actually has been consistently profitable for 3 years, more or less, but with a 40% win rate. But it's profitable because the average win is 2.5 times as big as their average loss.
Understanding the math of your strategy that's the game. You could probably teach me that strategy, and I may not still be able to trade it because maybe I don't like those numbers. Maybe I want a
Mm,
higher win rate or something like that. But yeah, that's ultimately the game, is
mm,
your win rate, what you're comfortable with, and the size of wins and losses. And I think a lot of beginning traders, if you're starting from nothing, you ultimately, to get those numbers in a quicker way to get up to speed, this is where you get into back testing. And
mm,
then you can see, okay, how did this do? And let me clarify, automated back testing, because a lot of people will go back and just manually back test the last month or two, but you really want an
mm,
automated back test that you can go back a couple years or a certain number of trades, 100 trades or something like that. So you can get those numbers. And once you
mm.
have those numbers, then you'll have that confidence that you're looking for.
So, what do we mean by position sizing? How do we define it?
The way I define it is how much you're risking per trade. I base
Mm,
my position size on risk. And depending on what you're trading, this might look a little bit different. So if you're just trading stock, for example, and let's say you want to buy $10,000 of stock and you want to have a 10% stop, you're
mm,
going to use $10,000 of capital and you're going to be risking $1,000. Your risk and your allocation for that trade are maybe different, for example.
mm,
So I do a lot of credit spreads, defined risk spreads, and those have a max loss and a max gain. So
mm,
in my case, I might risk the max loss, and then I can define that risk according to my account size. So, for example, if I want to risk 1% of my account on a trade, I know if the max loss is $300 for that spread, I know I could trade three of those. And then I'm
mm.
staying in that position size. So for me, I'm choosing the number of contracts
Mm.
based on how much I'm willing to lose for that particular trade. That's how I see that.
And you have prepared a couple of examples for us just to illustrate how this works.
All right, so I have a few examples that I want to show you about position sizing. And again, what I mentioned before was it's important to know I'm going to just call it the stats of your strategy, which could be, or which is the win rate, the average winner, and average loser. This particular strategy is a option strategy called a put credit spread on SPX, and it basically takes a trade once per week if certain conditions are met. So we can get into the actual strategy later, but here are the stats that over the past, I'm going to call it 18 months or so, it has a 73% win rate. The average loser is just under $300, and the average winner is just over $200. So I'm going to loosely call this a 3-to-2 risk reward. We're risking 300 to make 200. And again, we've had a 73% win rate over the last 18 months. What this does is create an expectancy. So when we crunch all the numbers here, every time I risk my $300, I'm going to make $75 over the last 18 months. So this is the expectancy. If we scroll down, another thing that you might want to be okay with your strategy is the actual P&L curve. And so in this case, we have a relatively smooth P&L curve that goes from the bottom left to the upper right. Sometimes you'll see huge spikes and huge drawdowns, and it's very kind of choppy and a lot of gut checks. And so this is a relatively smooth P&L curve, although there is a little bit of a drawdown right here. And this example has a $100,000 account that we're running this again, but we're only trading one contract at a time. So this really, to me, isn't an allocation or position size. This is the minimum you can actually trade. So
Mm.
what we're going to do now is look at the same trade and the same stats, but we're going to allocate our position size based on how much we want to risk. So this example, it's the exact same strategy. We can still see our 73% win rate, our average loser and winner, our expectancy, all of these stats are the same. But this time in that same $100,000 account, we're going to allocate 1% of the portfolio. So, in this manner, the word allocation and risk is basically interchangeable. So, if we're risking $300 per trade and we want to allocate or risk 1%, 1% of 100,000 is 1,000. Therefore, we could trade three contracts at a time to start this strategy. And if we look just real quick at the trade log here, in the very first trade, we took three contracts. So this is the position size. It's based on how much you're risking and how much of your account you want to risk for that one trade. So over time, as the account grows, then the strategy could then trade four contracts or five contracts. And that's how you can grow your account by allocating the same portion or the same amount of risk based on the account. So in this case, by risking 1% of the portfolio, this strategy had a almost 5% CAGR. That means it made almost 5% per year the last couple of years on the entire account. I think this
Mm.
also shows the leverage that options bring and why we want to keep the options allocation low, because we also had a, let's call it 3% drawdown on the entire portfolio over the course of that same time. So this is where, now that we have the win rate, the winner, the loser, the expectancy set, now we can decide how much do I want to allocate. And there isn't a right answer here. It's really what you're comfortable with. So this is the 1% allocation for that same strategy. It made about 9,000 in that account. And keep in mind, the rest of the account is basically in cash and you can do whatever else you want with it. Maybe you can invest in the index fund or whatever, but we're just risking a small amount for this allocation.
Can you show the P&L curve so we have a look at how that looks?
Yeah.
Still pretty steady.
Yeah. It's not the same, but it's relatively steady. So the next example, we're just going to notch it up a little bit and we're going to go with a 2% allocation. And
Mm.
again, same strategy. We're just risking a little bit more, meaning more contracts. So at 2%, our first trade ended up with seven contracts, whereas the previous one, 1%, we ended up with three contracts.
Mm.
The P&L curve is still relatively the same, but
Mm.
now we can look at a 10% CAGR for the last 2 years. That means the total account is making about 10% per year. The year 2024 is not over. This only runs to November, so it's not quite the entire year. And it made about $21,000 on the entire account, risking 2% at a time. And again, all these numbers stay the same.
But the
Now,
drawdowns are getting a bit bigger.
the drawdown is also getting a bit bigger because now you're risking 2%. And so let's say you had, this is 6%. Let's just say, loosely say, what this is telling me is you probably had three losing trades in a row since you're risking
Mm.
2%, and
Mm.
you ended up with a 6% drawdown. And that was probably actually, if you look at the P&L curve, you can see that here. So here we get a
Right.
little bit of wins, loss, and the nice little win streak. No trades for a while because the conditions weren't met. But you get the idea here that
Mm.
we did have a 6% drawdown, which is,
Mm.
I'm guessing, three losers in a row for this particular back test.
Right. And in your last example, I guess you are upping the risk even more.
Yes, we're going to go 3%. And if you want, we can have some fun and go higher, but you can see how volatile things can get. And maybe that'll be fun. But 3%, again, same stats, our expectancy is 75%. But now look at our CAGR is really up to 17% over the last couple of years. That made 34,000, risking 3% at a time. But again, that max drawdown actually comes back. So this makes sense. 3 losing trades in a row, you're going to lose 9% or so, give or take, if you're risking 3% per trade. But again, the P&L curve is still relatively the same. And you still have the same drawdowns in the same place. So this is an example of how your position sizing can greatly determine the outcome of your account.
Mm.
And if we want, we can do something. Let's risk 10%. And this is definitely not a recommendation. I try to stick to that 1 or 2% range personally.
Mm. I personally also have that as a rule. 2% maximum is what I'm willing to risk on
Yeah.
a specific day.
And I think depending on your account size, that's going to vary. If you're a beginning options trader
Mm.
and you're starting with let's say a $5,000 account, and you want to risk $300 on a trade or something like that, what's that? That's 6%. So, from an allocation standpoint, smaller accounts are going to probably naturally risk a little bit more. And hopefully, that's not your entire portfolio. That's just something to kind of keep in mind. But here is risking 10% for each trade and same stats, right? But the drawdown was much greater, 30%. And it still makes sense if we're risking 10% per trade
Mm.
and we have 3 losers in a row, we're going to have a 30% drawdown. But this
Mm.
66% per year over the last couple of years. Again, not a recommendation. This is just one particular trade that I do. This is a Monday trade. And then the idea is you have multiple trades that you can allocate separate amounts to. And then you can
Mm.
keep the position size small per trade or per strategy. But if you
Mm.
have multiple of those in your account, then you can see greater growth. But again, I'm just showing this as an example of how, as you risk more per trade, the volatility in your account can also increase.
But how much does this also have to do with our personal trading style? Because we are different, right? In how much risk we are willing to tolerate and how big drawdowns we are comfortable with.
I work with a lot of traders on some of these strategies, and everyone's got a different take on it. And it really is your personality. And I think it also depends what else you're trading.
Mm.
For example, if let's say I'm net long, which I am most of the time, and there's an economic event coming up, I may not take a full position ahead of FOMC, for example. I may not want that much risk on. And this gets into a little bit more discretionary sort of risk management of
Mm.
if something's happening and do you really want to risk 10%? Maybe you dial it back, or maybe you skip a trade because you don't want to hold through a FOMC, which is something we do. But I think it also depends what else you're trading. This is just one strategy for one day of the week.
Mm.
And if you are trading multiple tickers, I think you just have to keep in mind like what your total long exposure or short
Mm.
exposure is. How I don't like to use the word diversified. I think that's a tricky word, but you want to understand how much total risk you have on. And
Mm.
if you have longer term strategies that you're like not buy and hold, but maybe you're selling covered calls on dividend stocks, you may have a different approach to that risk
Mm.
management or that style. You may be okay holding through the downturn. So I think you have to look at all of your strategies that you want to implement and see how they work together.
Look at them like a portfolio, so to
Look
speak.
at it
There,
more like a
some are
portfolio.
more stable with fewer and smaller drawdowns, while you can maybe risk a small part of your portfolio for more volatile strategies.
Yeah. And I think it all comes down to the smaller you can allocate, the better. If you can truly stick to 1%, maybe 2%, and let's say this strategy makes you 5% a year, maybe you have another strategy that's 1% that makes you 5% a year. And then a third strategy you can allocate at 5% a year. You know, hopefully you can get this percentage up with your collection of strategies or your total portfolio.
Are there any common pitfalls that you see traders fall into when it comes to how they size their trades?
I think I wouldn't call it a pitfall, but I do think that if you are an option buyer, I think it can be tricky to be consistent in your size, because if you depending on where you're buying your options, if you're buying at the money options with 30 days to expiration, let's say you're kind of like a swing trader, well, the volatility can vary, which means the price of that option could vary. So one day that option could, the at the money option could be, let's just say $1,000, and another day it could be $800, and another day it could be, $1,500.
Mhm.
So there's some variance there with, if you say, hey, I want to risk $1,000 per trade,
Mhm.
then you may have to change the strike you're selecting, which also would change maybe your management of the trade where you take profits. So I think
Mhm.
it's trickier with buying options in that way. I think if you look at things like wider spreads, you can be a little bit more consistent in your size. That's not always
Mhm.
the best answer there, but I think what you don't want to do is say, oh, I want to risk $1,000, and you buy an at the money spread. You have a choice, right? You can buy an at the money call option for $1,000, or you can buy 5 call options at $200 that are out of the money. So a lot of
Mhm.
people in the beginning, you'll think, oh, I'm risking the same amount, but your probability is much
Mhm.
lower with those cheap options. So
Mhm. Mhm.
that kind of gets back into what's your win rate and your strike selection when it comes to option, because there's a lot of probabilities built in.
Mhm.
Your win rate with buying out of the money options is going to be much lower than if you're buying in the money options, for example. So that's probably the biggest maybe pitfall or hurdle when it comes to position sizing is, do you have a consistent strike selection duration mechanism inside of your strategy? Like this example, this is a 7-day put spread. So the duration is the same. It's
Mhm.
always 7 days. And our delta, where this is an at the money spread, delta 48
Mhm.
and 5 points wide. So we have some consistency in our entry time and
Mhm.
our technical setup. We have consistency in the duration. We have consistency in strike selection. That's going to give me more confidence that this win
Mhm.
rate is going to play out over time.
But it's also strikes me that if you really want to take advantage of this way of thinking and of calculating your trades, you need at least two things. You need to be very disciplined about how you execute your strategies, that you actually have some mechanics. And you also need to somehow be able to log and analyze them in a systematic way so you can actually follow up on this.
You're right. One thing that I started doing last year, because I've got this dialed in so well, is I'm deploying some automation software to help me with the execution. And then, what I've found is you'll notice there's no stops and targets and things like that on here. This is kind of entering the trade and letting it go to expiration and just kind of letting the math play out.
Mm,
So I found that this is much more, the real world lines up much more with the back test in that way. The more parameters and trailing stops and targets and all these things, the more things you add, I think in the back test, the less that plays out in the real world. So I think going through this exercise and finding a mechanical strategy is what you
mhm.
really need to get to the position sizing part of your journey.
You said in the beginning that this is maybe something that doesn't come in the first phase for most traders. So, what would be your advice to beginning options traders?
For beginning options traders, I think learning the basic strategies, the inherent risks of them, such as assignment, the idea of selling naked options, it seems like it's high probability, but it's very risky if things go wrong and those type of
Mm,
things. A lot of people get into options for
mm,
leverage and because they have smaller accounts, but they want to get bigger gains. And I think you can
mm,
do that. These type of strategies clearly show that risking 1% of your account, it can make a difference on the entire account.
mm,
But I think, what do you want to trade? Why do you want to trade it? SPX is maybe a little bit more boring. Some people want to trade Tesla, they want to trade the news. And so I think there's a tuition that everyone ends up paying, or they figure out, okay, that worked for a while, but now that doesn't work. Now what do I do? So I usually steer people towards indexes because they're a
Mm,
little bit easier to follow. You don't have to worry about a news event, for example, with Apple or
mm,
Tesla or something like that. So I like SPX because there's no assignment risk. And there's even a smaller version, XSP, which is
mm,
dollar wide strikes. So you can start to mess around with a strategy like this
mm,
or whatever. If you have a swing trading strategy and you can buy a call spread in
mm,
XSP for $50 and
yeah.
risk 50 to make 50
Mm,
kind of thing. So you can start small. And I think that's the best way is to start small. I also like gearing people towards the S&P. Maybe it's SPY, SPX, because
mm,
ultimately most stocks are going to follow the index.
mm,
The S&P 500 is probably your best indicator. What I would definitely recommend is find one thing to trade. And maybe that's for me, my primary is SPX.
mm,
Find one thing, one strategy, one option structure, and just focus on that one thing. Or maybe that's credit spreads, maybe that's iron condors, and just become an expert in that one strategy, on that one ticker, in that
mm.
one duration. And I think that's where you really got to focus in on. And it's focus is actually harder than it sounds.
That's very good advice. If I give you 30 seconds to sum up what we have been through, the most important advice, what would you say?
Position sizing is the probably biggest decision or the biggest factor to actually growing your account. You
Mm,
do need to have a strategy and understand the math of your strategy before you can get to position sizing. Until then, you should just trade very small. And I think back testing is probably the fastest way to get you there so that you can see how a strategy works. And so with something like this, I know over 2 years, this has done 73% and the P&L curve looks decent. So I'm going to have that confidence to keep putting on the trade on. Even if I get a losing trade, I'm going to feel okay putting the next trade on.
Where can people find you and connect with you?
Sure. I'm over on Twitter. I'll give you my links. My handle on Twitter is all one word option assassin. You can also find me on the Stock Market Options Trading podcast, the Stock Market Options Trading YouTube channel, and then I run the Alpha Crunching site, which is unique indicators and metrics for the S&P 500.